Well, hello everyone. Don Garman here from Mirador Capital Partners. Yet again, here we are in August. The year just keeps ripping along. After what was, I think most would agree, a relatively pleasant July. So we go and we're mostly through or largely through with some biggies tomorrow and Thursday, earnings season, which obviously has largely been pretty well received. I'm going to spend today's time talking about a broader subject and theme and what explains some of the positioning that we stick with and why, and going forward, why I think it will hold us in relatively good position. So permit me to share my screen here. So what you ought to be seeing is a 20-year chart of three colored lines. And the three colored lines are, the blue is the standard, the S&P 500, which everybody has heard of and knows well. The green is the Russell 2000, which is the 2000 small companies. So there's the top 500, the S&P 500, and then there's the ones that aren't large enough to get into the top 500. And depending on how many of them total there used to be 5,000 in the Wilshire 5,000. I don't even think there's that many in there anymore because there's not that many public companies, but there is 2,000 in the Russell 2000. And if you add them all up, the entire 2,000 companies are about the size of Apple in terms of market cap. They're about the same. And then the orange line at the bottom is non-US small, they're called emerging markets. So these are the smaller but presumably faster growing emerging markets in the world that you can invest in stock markets in or companies in. So why do I bring this up? What point am I trying to make? So what you should be able to see is that there were periods more to the 20-year ago period of the chart where orange was the best performing of the three, and then green, and then blue. And then we remember, well, the last global financial crisis where everything kind of converged. Obviously, everything went down, and then the recovery where the orange once again was the best performer, then green, then blue, and then describing what you can see easily, which is there was a long period of time where green was the outperformer, then blue, then orange. And we're now on the far right up to current day in a condition where blue is bigger than green, is much bigger than orange. So what am I hinting at here? What am I talking about? So one of the relationships that can be useful in long-term investing is the simple concept of reversion to the mean. A lot of things, if you look 20 years before this at a 40-year chart, it would look somewhat similar. Things kind of have their era, their decade, or sometimes 2 decades. But it's uncommon that things continue to outperform persistently uninterrupted for 30, 40, 50 years. So what is the point I'm making with making that relatively obvious observation? So this year has been better than many, myself included, would have expected, because what I have focused on over long periods of time in my career, as we've seen before and as I've showed before, is the chart of earnings and the growth of earnings. So this is a great line to focus on, because you can see going back to 09, the S&P 500 earned $61. And if you just equated this to your own income and net worth, and 2022, it earned $216. So if your earnings went from 61,000 to 215,000 in that period of time, your net worth should have grown, or in theory. And obviously I'm oversimplifying, but that's really the name of the game, is to track and follow that number. And the growth of earnings through time has allowed the value of the companies that produce those earnings to grow over time. And that's why we've talked about it before. Companies sell stuff, they have inflationary pressures, they raise the price of their stuff, and so they try to preserve their profit margin, and that's how the system more or less works. That's sort of capitalism over the longer term. So this number, this 2023 earnings number, has been questioned and challenged. And you might recall, if you've watched every video dutifully, that number was supposed to be $254 when we were looking forward back in the middle of 2022. So from 254 expected, it was gone all the way down to 218, but it appears to have bottomed. And that is a little bit of an explanation for why I think things have stabilized a lot. And the Fed appears to be nearing the end of this cycle. So this obviously is now the number, as we're in the second half of this year, that we're starting to price in and expect. So my point here is that the Magnificent Seven, or the seven market cap leading companies that have accounted for much of this rally, have gotten a lot more expensive. And so the reality is, this last month, we've done quite a bit better than might have been predicted based on our positioning. How can that be? Well, because the small cap index is starting to play a little bit of catch up. And that affects our positioning quite a bit, because we like to maintain exposure in a very practical, common sense way. Small companies should outperform large companies by virtue of the fact that they ought to grow faster. And even though they're a little riskier and more volatile, that's the idea. And that's been true, observably true, over a long period of time, 100 years. So we do expect that small caps will play catch up. In fact, we do expect that international will play catch up. What was super easy to see from that chart is we've gone 15 years of emerging market underperformance relative to US companies of any size. So that is, so that might be a clue to where some additional new positioning will be coming in the weeks and months down the road here. But so as we get into the summer, as you've seen, there's been more changes than usual in the last 30 days to try to reflect the parting of some clouds and some things that we think are reasonably easy to expect over the next 6 months. That accounts for that change. And but we're pretty happy with where we sit going into kind of what could be sort of some doldrums here as we move into Q4, which has generally been a pretty good quarter. So I'll leave it there. That was a little bit technical, but as always, we're here if you have questions. We're grateful to report a couple of new hires, which I think will have their bios in the notification accompanying this email. And if not this, then very soon we'll be announcing them separately. And then both Audrey and Amber have had the benefit of a couple days off. Audrey a couple more than a couple days. And really, I would almost say the first true vacation she's had in the last decade since we've been open. So we're very happy for that, but everybody else is here and we're ready to go. So if you need anything, let us know. And I will leave it there and talk to you next month, unless you need something sooner. All right. Thanks, everyone. Bye.